today's headlines are focused on the rise in COVID-19 cases, although that's been the headline every day during the 8-day rally for NASDAQ and, of course, the 6 out of 8-day winning streak for the S&P. Now, I got to tell you, I've had other concerns, including the concentration of winners in just a few stocks. And I'm not just talking about those momentum darlings, but coming into today, only 142 of 500 S&P names were higher for the year. And after weeks of taking money out of the market, I'm talking billions of dollars, investors had finally put a ton of money into the market, right? But that was just in time for that July 11th hit. And then they pulled out $26 billion last week. Now, the good news is that there are trillions of dollars on the sidelines. And at some point, a lot of that money will pour back into the market. The big question, of course, is when. And on that, I'd like to bring in Kaltbaum Capital Management President, Fox Business contributor, Gary Kaltbaum, along with Bull Tick Capital Markets Chief Strategist, Kathryn Rooney-Vera. First, let's talk about this session. And Gary, your concerns, beyond the COVID or maybe the COVID-19 headlines.
Well, look, we have two markets. I can tell you that 75% of the market, I call the opening up market, is really rolling over. Airlines, cruise lines, energy, financials, economically sensitives, they're really getting in trouble. The other 25% has been the NASDAQ 100, biotech software, and things like that. And what you're seeing now, the 75% is getting worse, and the 25% is finally pulling back after just going en fuego over the last 2 or 3 weeks. I'm just going to concentrate very simply on the leaders, which is holding up best as we pull back. We probably have more to go, but I must tell you, if anything's going to undo this, it is the virus. And we've been saying that all along. It really controls a lot. And when you see the news out in New York, Connecticut, New Jersey, that me in Florida cannot go there unless I have to quarantine, that's possibly problematic. So something I'm watching very closely, but leave no doubt you have a very split tape right here and probably go on the defensive for a little bit of time now.
Okay, I said I'd be a lot more worried if those states would stop people from leaving. That's when I'm going to panic. Right. Kathryn, what do you make of today's session and sort of the message to the market, particularly today?
Yeah, no, and I'll agree, Charles. I think the migration has de facto been one way rather than the other way. But I think Gary and I are probably both from the tri-state area. We do want to go home to visit our family. But the fact is that Gary's right. The virus is what could precipitate, rather than a V-shaped recovery, potentially a W-shaped recovery. And that's what I'm focused on. I think the virus really takes an impact on both markets and economy if one of two things happens, or both simultaneously. One is we get additional lockdowns. Here in Florida, Governor DeSantis has said that's unlikely to come to fruition. But the fact is that in my state, the case count has jumped from new cases 700 to 5,000 just yesterday. So that's one threat. The second threat is if you get that incipient jump in consumer confidence, returning to negative. So we have to see consumer confidence continue its uptrend. If we get that, then I think we can get through this second wave.
All right, so, Gary, I watched these fund flows, and for a while people were saying Tina. I thought it was an excuse for people who missed the stock market, suggesting it was the only game in town, because every week one thing is constant. Billions of dollars go into bonds. And almost rarely does money go into the stock market, at least from fund flows. So investors are jittery. What do you think ultimately it will take for the masses to come back into this market, Gary?
Well, first off, I don't know what the heck anybody's buying bonds for. And I noticed in Austria today, they sold a 100-year bond at less than 1%. I don't know what those. I don't know what those investors think. Look, let me say this. The one thing we have been seeing recently is a lot of retail trading and a lot of junk, a lot of speculation, a lot of froth, and a lot of names going from 50 cents up to 5. So that's indicative of worrisome. I don't like outside speculation, but there's nothing like markets moving up to attract more money. I think we've been seeing some of that. But I still think more people are wounded from years ago as well as the recent crash. So it's just a matter of the markets constantly doing better and people feeling better. And just keep in mind, though, we are pounded away every day by the news of what's been going on. Here in Florida today, the largest number of cases we've had since day one, and that's something that affects people's psyche.
Yeah, no, I think the upcoming consumer confidence reads are going to be important, although how much they get in recent headlines depends. But, one thing is gold is higher for the year. But, Kathryn, when we look at some of these traditional stock market havens like utilities, real estate, they haven't performed that well. So, you and Gary are both expressing some concern here, at least short term. Where does an investor camp out during these sort of periods of uncertainty?
Well, I'm with you, Charles. I think gold is a very good asset to hold in your portfolio. If you want to protect your portfolio, make it relatively more immune to market downturns. So gold is, of course, an inflation hedge. I think we are going to get bouts of inflation over the course of the next few years, not in the near term, but certainly it's also a risk aversion trade in gold. I also like utilities. Utilities are kind of the substitute for bonds. As Gary said, bonds are yielding nothing. You have the ECB at negative interest rates, castigating their banks, and the U.S. Potentially going in the same direction. I doubt it, but it could happen. But I would say one thing on the fixed income space that a lot of people are not talking about. Look at fallen angels. Fallen angels are those bonds that have lost their investment grade rating in recent history. We're talking 1 or 2 months. We're talking Ford, the likes of these names, which have the backing explicitly, by the Fed. The Fed is buying some of these names in a direct manner. And I don't think names like Ford are ever going to be allowed to go under. So you can get these names at 5 to 8% yields per year. And I think that's interesting as we get closer to, record highs.
Gary, I know that you've been buying dips successfully. Do you park money and things like, in anything other than cash right now?
Cash at 0% interest rates. That's all you really can do. And I got to tell you, I used to have a great income business, not anymore, because I'm not going to go out long on the yield curve and get nothing. So not much you can do. And right now I have a pretty good cash buildup, and I'm just watching all the leaders, see where they pull them back into. And I'm going to buy when everybody's sick to their stomachs. And I think we're going to have a little more downside here. I'm not sure how much. I do expect 5% pullback. Jay Powellitis will show up with something, and we'll probably be off. But again, I think right now a little defense works, and 75% of the market just is not making the. And I'd be careful.
All right. Well, I'll be side by side with you when it's time to buy this latest dip for sure. Kathryn, Gary, thank you both very much as usual, folks.